Welcome to another episode in the Business Ready for Sale podcast series. My name's John Denton, and it's my pleasure to be your host today. These podcasts bring you information and interviews and presentations all around things associated to do with getting your business ready for sale. Why get your business ready for sale? Because a business that's ready for sale is well worth keeping. In this episode, it's my great pleasure to be joined by Tony Monisse from Brentnalls WA, and that's WA, Western Australia. Tony and I have known each other for a very long time now, and it was through Tony that my business partner and I were able to change strategy on a business that we had many years ago, which resulted in us making more profit and making the business more saleable and selling the business for more money. And this is the kind of thing that Tony is passionate about doing. It's about looking at your numbers, understanding your numbers, and then developing a strategy around those to get the maximum growth and profit and success out of your business. Today, this is a recording from a webinar that Tony did for me around balance sheets. Now, it might not sound like a very interesting topic, but the thing is, when businesses are selling, when people are selling their business, the emphasis tends to be on the profit and loss statements. And even when business owners are running their businesses, if they look at their financials at all, they tend to focus on the profit and loss. And the balance sheet can sometimes get out of whack or become as Tony calls it, a lazy balance sheet, and all things can go amiss. And smart buyers will look at a balance sheet. They can tell, and Tony can tell a whole lot about a business just by the state of the balance sheet. And so that's the purpose behind today's podcast. So I'm going to shut up now and go over to the recording from the webinar. If you'd like copies of the handouts or the slides or anything from this podcast webinar, then please just email me at john@johndenton.com.au, and you can find out all the other things that I do for business owners in relation to getting their businesses ready for sale on the website, johndenton.com.au. So without further ado, let's go over to the webinar. Welcome everybody to this webinar. Welcome if you're watching live, well done, and welcome if you're watching the recording. And welcome as well if you're listening to the podcast. My name's John Denton. My business is called Business Owners Taking Action, and it's my great pleasure today to have Tony Monisse from Brentnalls WA here. Good morning, Tony.
Morning, John. It's a nice, wet, windy morning.
Yeah, we don't get too many of those in Perth, though. So, Tony, I was thinking about this yesterday. You know, it must be 20 years since we first met. I think it was 2003.
Yeah.
When a mutual client told us we should be talking to you and told you should be talking to us. And we bumped into each other at a national speakers evening.
Yes. Yeah. I've been wanting to catch up with you all, be introduced to yourselves, and I guess by chance we ended up sitting at the same table.
Yeah, that's right. So your hair was a different color then, and I actually had hair then.
Yes, it was another world, wasn't it?
It was indeed. But just for the people watching, listening, as a result of that meeting, my business partner and I got Tony on board to look at our numbers and analyze our numbers, because my business partner Peter and I were working on getting our business ready for sale and looking to sell in 2 or 3 years' time. And as a result of Tony, engaging Tony and getting Tony to analyze all our numbers, we adopted a completely different strategy, business strategy as a result of that, which not only greatly increased our turnover over the next 2.5 years, but also our profit and therefore the value of our business. And we were able to sell it and get a very good price for it. So it all started with Tony's intervention. So thanking you for that, Tony.
Yeah, it's a great story, John. how you and Peter came together, and just with some focus, we're able to just turn the business around very quickly.
And that's the great thing, I think, about the work that you do. It's not just a case of looking at the numbers, but it's looking at the numbers and thinking about the business and how the business, coming up with some strategies for the business based on what the numbers are telling you.
Yes. Yeah. And I think that's the challenge I see. And, we'll talk about it a little bit more, but, John, that often there's a disconnect between the numbers and what people are doing, what they're doing in their businesses. And I guess in a sense, it's how do you connect, what people do and the numbers you should, you should be focusing on to achieve the outcome, because often people are focusing on things that don't make a lot of difference to the numbers.
Absolutely. Most business owners that I work with will look at their profit and loss to see how they're going from time to time, but not many of them look at their balance sheet or take any notice of their balance sheet. So, Tony, tell us a little bit about your background. Maybe I know you've got a presentation there that you'd like to run through, so why don't we start with that?
Okay, here we'll go. So I'll just share my screen. So hopefully this is all right. Just in terms of the topic. So just a little bit about me. I'm a chartered accountant. I had lots of, actually just 30 years, marked 30 years since I started the business. And, I'm fortunate I've got a number of, people that have come into our business and help work with me and work with clients directly. So, business is certainly not about me. And I guess, when I started out, I was, a lot of the time was just, I was doing tax returns, but I just felt there needed to be more. And I had, I guess, a number of sort of experiences where, I needed to provide greater insight. And I had one particular client, and he's the angry one there. He was shouting at me one day. His name was Ern. You can see with his finger pointing at me, and he goes, "I want a forward-looking accountant." And this was early in my career and early in my practice, and I thought, look, I've got to find a different way. And so I got a picture of New York there. So I decided to take my family for a holiday, and we went to New York, and I did some programs on strategy, and I looked at how I could connect strategy and numbers, and and hence the journey now and all the different client experiences that brought us to where we are today. So maybe I think I was talking to John. We were talking about this the other day, and I think often people are checking the fuel gauge, which is a bit like your profit and loss, but maybe they're not checking the tire pressure, which is your balance sheet. And sometimes if you just focus on your P&L but you don't focus on your balance sheet, then you may not get to the end of your journey. So or you may need some remedial help to get there. So I encourage people to not only focus on their profit and loss, which is obviously really important, but to understand their balance sheet. So that's probably a little bit about today. I think the number one thing is that is most businesses, and we see all sorts of businesses, they're just organized. They're not organized. And it surprises me. I mean, we've just been working with a business recently. They're turning over $6 million, and they're not producing accurate financial statements and certainly not producing accurate balance sheets. So I think the first thing is that it's important that businesses get organized so that I talk about they can produce accurate, relevant, and timely financials. I think the next thing, and sorry, John, did you?
I was going to say, the question a lot of people ask is, why is it called a balance sheet?
Good question. And you did make me think about this question. So accounting is the basis of accounting is double entry bookkeeping. So for every debit entry, there's a credit entry. So by definition, when you're processing information in an accounting system, the debit entries should equal the credit entries. And if they don't, then it's likely that your balance sheet won't balance. So And I've seen that. I've seen where balance sheets don't balance, and that is a real concern. So in essence, the balance sheet is about balancing all the entries in the system. And if the balance sheet balances, then you know everything's been posted, at least been posted, the debit side of the entries and the credit side of the entries. And then it's also at a higher level, which I'll explain a little bit further. It's about how does the there's an equation that sets the balance sheet. So if it's okay, John, I'll go through that equation in a moment.
Yep, sure. No problems.
I think the other thing too with balance sheets is most businesses produce balance sheets that come straight out of their Xero or, they come out of MYOB or whatever accounting system. But often those balance sheets and financial statements aren't designed to run the business. So, often they're designed to submit to the bank. They're designed for the tax office. They're designed for lodgement with ASIC, but they're not designed to run the business. So I think that's a really important point to make, because often I look at balance sheets and I don't understand balance sheets. So I'll talk a little bit about that further. Look, one of the reasons why, and look, these are the typical things that we see, in a balance sheet that is not correct. And I've put some adjustments. And John, I don't know what your experience has been, but, often when I work, there's often a number of adjustments that aren't posted in profit and losses and hence balance sheets. But I don't know. I mean, I presume you see that when you start working with coaching clients.
Yeah, it's of course when the people are coming to sell their business, then it's surprising how many times they haven't looked at the balance sheet, and things are just out of whack. All kinds of things to do with the stock, plant and equipment. It just makes everything so difficult at that point. But of course, it's not a 5-minute job to fix it up.
No. And I apologize on the layout of this slide. It must have just been something. But so often the things that we often see when we work with clients for the first time and we start looking at their balance sheets and their P&Ls is often, higher purchase liabilities aren't being reconciled at the end of each period. Often, there's prepayments that aren't being recognized. A lot of businesses have, they'll have a large insurance premium that will come in through in 1 month, but that insurance premium relates to multiple months. So often they expense it in 1 month. So that distorts the numbers in that particular month, and then it distorts all the other numbers. Often businesses, they're largely doing stuff on a cash basis, so they're not taking up accrued expenses. So we're not getting the proper matching of income and expenditure. Often we see on a lot of balance sheets, there's no annual leave or long service leave. So they've got, they've had employees working in their business for a long period of time, and there's been no recognition of the annual leave or the long service leave. Other areas we often see is work in progress. So especially in sort of contracting type businesses, often they've got billings happening in, they bill the client in 1 month, but the costs are being incurred in another month. So they don't recognize what's referred to as work in progress. John, you mentioned inventory. We work with one particular business, and when we came in to look at this business, I saw its stock levels inventory was about $3 million, and the business was only turning over about $5 million at the time. And I said to my business partner, I said, look, that's the highest level of stock I've ever seen in a business. Anyway, I rang the client and he said, my stock isn't $3 million, it's only $1.5 million. I said, well, your financial statements are showing $3 million. They'd never done a stock take in probably 2-3 years, and they were still waiting on the accountant journal entries from about 3 years ago. So, but I see that, often you see that in businesses. I don't know, I suspect you see something similar, John.
Yeah.
And then often, I think, look, this is a really important one. Often businesses don't show their tax liability in the balance sheet. So, often I see it with a lot of businesses. They think I've got all this cash, but they're not providing for the tax. So I think that's a really important one. And then most recently, there's been a lot of businesses that have been taking advantage of the plant and equipment write-offs, which is great for tax purposes, but it actually distorts the balance sheet. So it's one of those situations where maybe for accounting, we should be showing the asset on the balance sheet, which I think helps that sort of overall position. But for tax, then we should be writing it off, and then that way we just do it as a tax adjustment rather than misstating the balance sheet because, I'm working with a business at the moment and, they've virtually got no assets, but they have got assets, but they've written them all off because they've bought all these assets for tax purposes, but it shows on the balance sheet that they've got no assets.
Yeah, makes it interesting when they come to sell.
Correct. And I think that's sometimes where it's important that, for accounting and tax that sometimes you need to do things for accounting purposes to show the true economic reality, but then you might treat it differently for tax purposes. Obviously, you want to maximize your tax position, but equally you want to present your financial statements in the best possible light, whether it's to to gauge how the business, and how well the business is going. I don't know if there's anything else you want to add to that, my list. I won't talk about some of the profit and loss adjustments, but I'll just talk about the balance sheet adjustments. But I don't know if there's anything else, John, that you want to add to that list.
That
From your experience when you look at balance sheets?
Just let people know that if they want a copy of these slides, they can email you and you'll give the email address later. Yeah,
100%. John, more than happy to share the slides. So if people just email me and I'll have my email address, that's more than happy to share the slides. And there's also at the end I've said, look, if anyone wants to just do a little bit of a review, then more than happy to have a look at those financial statements with someone and take them through a sort of a review process that we do when we're sort of working with clients. So I'll talk more about that at the end. So reasons to review your balance sheet. And again, thanks, John. A good question. And I think, as I said up there, and look, it's good that we've got a group here that do look at their balance sheet. I think that's fantastic. It says a lot about, I don't know, your audience, John, the fact that they do say that they review it, which is fantastic. But my experience is that, a few businesses, we see a lot of businesses that focus largely on the profit and loss and they don't focus on the balance sheet. So why is it important to look at your balance sheet? If you want to hide something, you hide it in the balance sheet. So often people are looking at their profit and loss thinking they've made a profit, but they actually might not have made a profit. They may actually, in fact, made a loss, because often the easiest place to hide something is on the P&L. So on the balance sheet. So if you're not looking at your balance sheet, then there's a risk that your profit and loss may be incorrect. So, for example, we talked about stock earlier. If stock is overstated, then that means that your profit and loss is going to be overstated. So, this client I was talking about thinking that, he's got a $3 million, when I looked at his accounts and he had $3 million of stock, and then he told me it's $1.5 million. It's actually only $1.5 million. That was actually a reduction in his profit of $1.5 million once we put that adjustment through. So, that's the reason why it's really important that businesses look at, their balance sheet, because, if you want to hide something, or not hide something, but if there's errors, then it's the errors get shown up in your balance sheet.
Yeah, and stock is an interesting one. I see a lot of stock manipulation, shall we call it, or stock adjustments to make figures look better. But, when people are buying a business, if they're smart, they will look at what's happened with the stock over a period of time.
Yep.
I guess it's one of the areas where I see the most, what would you call it? The business owners don't keep their stock up to date. And there's no excuse these days with the accounting systems that we've got, to keep you pretty accurate.
Yeah, look, what we did with this client that had this significantly overstated stock figure is that we actually started periodic stock takes where we didn't count all the stock, but on a periodic basis we counted a portion of the stock, and that way they were able to work through their stock on a regular basis to at least make sure it was correct. And look, what they did highlight was significant write-offs. And then we started investigating why were these write-offs happening, and then we found that actually, some of the invoices weren't being coded correctly. They were being coded to stock when they should have been coded straight to the profit and loss. So it highlighted that. I think the other reason why to look at your balance sheet is the solvency of the company. I'll talk a little bit about that. The working capital. I'll talk a little bit more about that, and even have we got enough money to pay our tax? So often that could be including the GST or BAS. Your BAS payment. So often businesses don't. They find they get to the end of the period and they haven't got enough money. So I think just having that solvency. I think it's just reviewing the financial health of the business generally, and I'll show an example of a client we work with in a moment. And, what sort of cash buffer does the business have? If the business, business does turn. So I guess just having a better understanding of the financial health. I think also, things like dividend policy, should we be paying out a dividend or not? What does the balance sheet look like? Should we reinvest back in the company or should we grow and take that? So I think, it's a really important reason why we need to look at our balance sheet. I think the other thing is, informed decisions, including funding. Is the balance sheet structured in the right way? Do we need to go out and get some debt funding? Do we need further? The shareholders need to contribute further money. So it's just understanding those sorts of things. And equally, and that ties back to, taking out dividends as well. I talked about lazy balance sheets, John, and I think, sometimes I had a breakfast with a client yesterday and, they had a business, had its challenges and struggling. And one of the things that they've been doing is selling off excess plant and equipment, because they actually don't need that plant and equipment. So it hasn't had any significant impact on the profitability of the business. But they've been able to realise a significant amount of proceeds from just selling plant and equipment. It's not that's surplus to the business. And the same with, I talk about working capital, but that's largely, debtors and stock, inventory. But, often we see businesses not collecting debtors fast enough or they're carrying too much inventory. So, we have these lazy balance sheets that could be easily turned into cash flow. So it's a really important point. I don't know if you got any comments on that, John, from your own perspective.
Yeah. The other thing is unsaleable stock. I know we're talking slightly different things, but there's so much cleaning up to do sometimes when a business owner is getting their business ready for sale. If the business has been going for a long time, then the lazy balance sheet, it gets so far out of whack that it makes it very difficult at that end point when you're trying to exit the business and attract buyers. So
correct, and which really speaks to the next point is, if you want to maximize goodwill, and that, John, and that's what this client, I was talking about from breakfast yesterday. You really want to optimize the assets you need to run the business, because that will basically typically generate a higher goodwill value than a business that's carrying excess stock or plant equipment doesn't necessarily need. It could be they could actually be selling themselves short, I guess, in terms of the exit of the business one day.
Well, okay.
So, what should a balance sheet look like? So this was something. So I think this is the biggest challenge I see with a lot of businesses, John, is that they don't organise the balance sheet. So what I've got here, so this is where the balance sheet should balance. On one side, we should have all the business assets and what's required to run the business, and on the right hand side, we should have the funding. And so the assets that you need should equal the funding, and that's where the balance sheet balances. Right? Now, this is not the traditional way that a balance sheet is presented in most financial statements. But if you really want to understand what's going on in the business, and I'll show you a couple of examples of that, your balance sheet needs to be organized in this manner. So, because I think the biggest challenge with balance sheets is lots of things are mixed up. Loan accounts are mixed up with, stock and debtors, and, you got liabilities mixed up with tax provisions and, creditors. And so it becomes very difficult to understand actually what's happening in the business. So I really encourage everyone to, look at this way of organizing their balance sheet, and it's something they can either export into an Excel or whatever, and I'll show you some examples of that. So on one side, we've got the business assets. So what are the business assets? They're current assets, which are typically debtors and stock. And then there's less the current liabilities, which are trade and other creditors. And the net of those two is what's referred to as working capital. So yeah, that's which is typically required to run the business. And then lastly, you need your property, plant, and equipment and any intangible assets. So they're effectively the assets to run the business. Now, so it's really important we isolate that in a business. And then on the right side is we've got, well, how are we funding those assets? Is it being funded by debt? Is it being funded by equity, which is the shareholders? Or is it being funded by some other means, which could be, dare I say, there's been a number of businesses funding their operations with money owing to the tax office. So it's probably just understanding where the fundings come from. So John, you and I could have similar businesses. We could have two similar type businesses, manufacturing businesses, but your business could be funded, with equity, and mine could be largely funded with debt. But if we're going to look at the true performance of the business, we need to isolate the business assets.
Yeah, absolutely. It's the balance sheet tells a whole different story to the P&L sometimes.
Yeah, and look, I've been looking at balance. I look at balance sheets and I got no idea how the owner understands this balance sheet because I can't understand it.
Well, quite often they don't.
No, I go. This is so unless I sort the balance sheet out into these categories, I can't understand the balance sheet. It's just so I really encourage people to look at the way they're presenting balance sheets, especially look if you want to do your balance sheets for the tax office, and great, just do it. That's fantastic. But or lodging with your bank. But if you want a balance sheet that helps you run your business, I really encourage people to sort of look at this way of presenting their balance sheet.
Yeah, working capital is an interesting one because a lot of buyers, when they're looking at a business, don't stop to consider the working capital that the business needs.
No.
So that's another expense on top of the price of the business, really.
Correct. Because you need to allow for that in your funding, because you can fund the purchase of the business and then you get in and 2 months later you haven't got any money.
Yeah, that's right.
Because, you're not collecting your money. So hopefully that's, but I'll show an example of that. So this is hopefully everyone can see that, and then I might switch over to Excel in a moment. John, is that coming up okay?
Yep.
So this is the client that we've been working with for a number of years, and be fair to say they had a sick balance sheet. Is my cursor showing there, John?
Yep.
Okay, so you can see this business. It's really been an interesting business journey, and Richard's done. He's had some really lean times. So you can see his revenue over a period of years. It actually declined and it was pretty flat, and it's growing again, but not substantially. But probably what's more important is that he was making very little money, and the last couple of years he's made some good money, which has been fantastic for him. Looking at exiting the business. So I guess what we're going to do is look at the balance sheet relative to this business. And I guess if you look at this business, this was when I talked about the business assets, these were the business assets that were required to run the business. It was 530,000. You can see the numbers. And the last couple of years, it's jumped to about 900,000 of assets that he's needed to run the business. So even though his revenue has not increased substantially, the assets required to run the business, have increased, quite significantly in the last 2 years. The major part of those assets is the working capital. So you can see that the working capital, so that's your debtors and your inventory, less your creditors. You can see the inventory, it was quite low, the working capital. And as a percentage of revenue, it was very low. But you can see in this last year, it's jumped to 11%. It was 6% in 2021 and 11% in 2022. And I think the key thing is what was it like? Is that good or bad? I guess is the question. But it's actually a good outcome that the business assets have increased, because what that means now is that the reason why his working capital has increased is he's stocking more stock. So he was often missing out on sales because he didn't have enough stock. Whereas with the profitability of the business, he's been able to invest in more stock and actually get the stock levels to where they should be. So, so we're actually quite comfortable that his working capital and his stock has increased, because what that means now is that when customers ring up, he's got the stock on the shelf, whereas before he would be missing out on sales and orders, prior. So, I think but if we didn't analyze his balance sheet in this way, we wouldn't be able to understand that. So I don't know, John, if there's any questions or anyone else has any questions on that.
Yeah, I mean, you would think at first glance that if the working capital has gone up as a percentage of your turnover, then it's probably a negative. But sometimes it's got to happen. You've got to fund the growth.
Correct. And and sometimes businesses don't. It's actually quite the opposite. It's not that they have too much working capital; they don't have enough working capital.
Mm. But it'll be interesting to see what happens with. Maybe I shouldn't mention this, but with Qantas now that, or when a CFO takes over the CEO's position, we're going to have a financial person running the company. My experience in the past of that sort of situation is that the first thing they do is look to cut costs.
Yep.
And you can't necessarily grow a business by cutting costs. It's just I worry about Qantas.
Yeah.
In that respect.
Yep.
I don't know if you got a view on that. But...
Well, and look, yeah, so be nice to accountants and CFOs, John. But yeah, but I think the other thing that I really want to point out about this balance sheet is, you see back here, the debt of the business, the external debt of the business was 708,000, but the assets of the business was 530,000. So they actually had more debt than they had business assets, which was effectively represented by losses. So they'd actually borrowed money to fund their losses, which is that negative equity. We roll forward 6 years, and you can see the equity of the business, because of profits over the years, has gone from 306 to $1 million. So there's actually got $1 million equity in the business. And the wonderful thing now is he's actually gone from having, like you can see here, it started to get better because the assets of the business were 563,000, but he only had 300,000 of net debt. So at least the debt wasn't greater than the assets. And now he's got to a point where he's actually got cash. So it's gone negative. So he's actually hasn't got debt anymore. He's actually got cash in the business. So he's actually got 800,000 in the bank. He's still got a term loan of 335,000 that he still owes. And then, so effectively what that means now is he's actually got net cash, and he's got $1 million equity in the business, which is a significantly healthier position now in terms of funding his business assets. And then what you can see here is we've actually started recording his tax payable because he had losses. So what we've got is, okay, well, we've got 813,000 in the bank, but we actually got to pay 280. So it's not all our money. So now we can start looking at dividend policies. In fact, we are looking at dividend policies for him and how much dividends he can take out with another shareholder. But I think if I can just sort of highlight the importance of sort of doing that type of analysis, John.
Yeah, absolutely. It's and it takes some experience and somebody like yourself just to see that. I mean, as a business owner, yeah, well, I wouldn't have a clue really to how to read that in the light that you just presented it.
Yeah. And I think this is a challenge, is people are looking at zero balance sheets off zero, but they're not organized in a way to actually help you make informed decisions and understand actually really what's going on. Because, what's absolutely critical here is you need to understand working capital. So, it's just really, really important. But that's one case study. I'm just conscious of time. I did have another one, but probably means I'm going to have to go to a, how are we going with time, John? I'm just sort of conscious, but I guess in a sense, the point is, really, it's really important that, businesses, understand the key components of what make up their balance sheet.
Yeah. Well, it starts with putting the correct data in, putting it in the correct format, but then also reviewing it and analysing it. And it, I always recommend to business owners that they get somebody like yourself or an external accountant to have a look at their figures. Yep. Because, I've had situations where when I've advised a business, when I've seen things in the financial that I don't understand or that look out of whack, I've said, look, why don't you get a different accountant to audit or just do a review of your financials? And of course, the typical answer is, but I've been working with this accountant for, 10 years, 20 years. But that's my point, is that sometimes the accountant needs some fresh eyes to look at the numbers as well.
Yeah.
And it's surprising what comes up. So I had one client who was reluctant to take that advice, but eventually, because an accountant offered to do it for them for nothing, they did that, and the things that it revealed were quite significant. All my suspicions about what was going on were correct.
Yeah.
And so, a fresh set of eyes is very valuable.
Yeah, look, I think, to that point, often, look, I think the challenge, and, I'm not sitting here as if we're perfect or anything like that, but I think the big challenge for a lot of accountants, and, I've seen it, is that, everyone's busy. They're busy with tax returns, lodgements, all that type of stuff. It's quite consuming, and it's probably getting more challenging in the current environment. There's less people around, or less people to, so there's a lot of pressure on the accounting industry generally. And I think, the challenge is that, if this is extremely good tax accountants, and look, often we've had situations where we've said, they stay with their tax, like you said, they stay with their tax accountant because there's a long-term relationship, and, we're not there to disturb it, but, often we'll come in and just focus more on the financial management side of the business and just help them with that stuff. And, they continue that relationship with the family accountant that they've had for the last 20 years. And because the challenge is that often it's that family accountant or whoever doesn't necessarily have the space or the skill set, do you know what I mean, to do the type of analysis. So, and it's just horses for courses. So, look, maybe I'll just show one last example. So this is that client I was talking about with the inventory. And again, I apologize, the numbers might be a bit small, but this business has grown substantially, 14 million. That was COVID period. And they work on a calendar year. Then they grew to 20 million and 34 million in this last calendar year. And you can see commensurately the profits have increased substantially. You can see that their profits have increased to, close to $4 million in this last year on a substantial increase in that. Now, what's interesting is I'm just going to actually focus on the balance sheets, the working capital side. So I talked about working capital being trade debtors and inventory, and I talked about current liabilities being trade creditors and other provisions. But what you can see here is that the stock levels, the debtors have actually decreased in this business as a percentage of revenue. So they were 14% of revenue, 10% of revenue, and they've dropped to something like 7%. So they've been very diligent in the collection of their money as they've grown their business. On the converse, you can see that their inventory levels have increased substantially. For a number of years, they were only turning over, they only had inventory around 2 million. That's grown to 6 million in this last year. Now, that, when you look at that as a percentage of revenue, you might go, well, their inventory is growing faster than their revenue. So that's probably not a good thing from a working capital perspective. But what they are doing is they are winning a number of projects. So the reason why the inventory is growing is because they're bringing in inventory or stock specifically for projects. And so that's the reason why they're in. So what we're actually doing in the background is analysis between what inventory is for projects versus their normal inventory. And their normal inventory is actually being managed quite well. The reason why we got the increase is because it's being brought in for specific projects. So that's where this analysis sort of becomes really, really important.
And I'll just repeat. If people want to get a copy of the PowerPoint, you can email Tony and then go through and watch the recording. Everybody will get a copy of the recording in a couple of hours' time after the webinar. And then you'll be able to look at the numbers and listen to the recording.
Just a couple of other things and then we'll wrap up, John. The other thing too here, and I talked about solvency earlier, is looking at the ratio between current assets and current liabilities. And typically and this is where looking at your balance sheet is really important, but because typically that ratio should at least, your current assets should, to your current liabilities, typically should be between 1 and 2 as a ratio. So what's really interesting about this business is as it's growing, even though its current assets have grown, its liabilities have also grown. So it's managed to maintain a ratio of 1.5 all the way through. So, as its current assets have grown, its current liabilities have grown, but it's maintained that ratio of current assets to current liabilities. And that's reflected in and the other thing that's really important in this business is that the net working capital of this business has stayed consistent at around 8, 9, 10%, which I think is again another great outcome for this business because the thing, as the business has grown, it's managed to keep its working capital as a percentage of revenue around the same. Again, another really, really important measure in a business. And lastly, you can see here, this is the profit relative to the business assets. And there's a pretty healthy return on net assets, return on capital, the last few years. So they've been generating 60% and 105% return on capital. So I guess what I'm trying to highlight here, it's really important to understand these levers in your business. But if you're not looking at your balance sheet in this way, so we've had clients come in and go, we've had to fix up their balance sheet, and it's been a 2-3 year journey to fix up their balance sheet to get it right.
Yeah. Is this, some of the numbers you've been talking about are pretty large numbers. Is this just as applicable for small businesses as well?
100%. Well, if I look at his previous business, Richard, he turns over 6-7 million, but he hasn't grown his business substantially, but we've just worked on improving his profitability and improving his balance sheet. That's his employees, 15 people.
Yeah.
But the principles apply exactly the same, John. 100%. I've been involved in big companies and small companies, and the principles are exactly the same.
Yeah. Okay.
Look, I think if there's any questions, I guess, I don't know if people have any questions, I guess was probably
we haven't had any questions come in, so
winder them as clients.
So two questions that come to my mind is, one is, when I look at my balance sheet, how do I know if it's correct or not? And then how do I fix it up if it's not correct?
Yeah, I think, I guess one is to review the balance sheet and to look at it. And, often we sit down with clients and when we review it, they go, that's not right. My stock or my planned equipment's not right. I've got more planned equipment. Most people know what it looks like. So it's reviewing it and going, no, that stock's not right. And then often it's the things that are missing, how do we haven't taken up annual leave provisions, or how do, how do we've incurred all these costs, but we haven't invoiced the customer yet. Those types of questions. And I guess that's probably also where, you really need to engage with someone that has, like you say, find an accountant or find someone that you can talk to that can actually, look at, what you're doing in your business and saying, okay, all right, now we need to start taking up some of these adjustments. And often, what we've found is we've had to work with a bookkeeper or internal accountant, whoever, and just show them how to start processing these adjustments so that, at the end of each month, their numbers are accurate.
Yeah. That, while you were talking, it made me think as well about, and you and I talked about this a little bit before, the difference between accrual accounting and cash accounting.
Yeah.
It's really getting down to basics, but, what is the difference in simple terms?
Well, look, it's a bit like the insurance prepayment, the insurance I talked about. On a cash basis, if you're just doing accounting on a cash basis, you may have paid that expense in June, but that expense relates to the next financial year. So what that means is in July, August, September, October, your insurance expense that was paid in June in the previous year is not being reflected in the profit and loss for those months. So accruals is about matching income and expenditure in the months that they relate to. So that's where the accounting adjustments come into play. Or, you may have incurred, you might be doing a contract and you've incurred a lot of costs in one month, but you don't invoice it to the next. One month's going to look really sad. The next month's going to look awesome. But, we're not matching the income and expenditure. So we need to look at an accounting adjustment so that we do match the expenses being incurred in one month with the income being generated in the next month.
Yeah, it's interesting. And the other thing is loans. I've again looked at a business's financials and looked at the balance sheet and then put it in front of the owner and started asking questions. And within a few minutes, the owner was saying, well, this is not right. I've been putting money into the business, but it's not showing up on the balance sheet.
100%.
So that's a big problem.
Yeah. 100%, John. Yeah. So look, that's where I think, and we've seen that too, and equally it can happen the other way where they're taking out drawings, but it's sitting somewhere else. It's in the profit and loss or whatever. So it's not showing the true results of the business. So yeah. And that's why I think it's really important that not only you review the balance sheet, but often it's what's missing from the balance sheet. And then that's also where you might want to engage with someone to help you, just understand your business and get the adjustments. Because often we find when we're working with businesses that, we have to actually set up a month-end checklist for them to actually, make sure that certain adjustments are being processed each month.
Yeah. Yeah.
And then we're getting more accurate because we've now got more accurate balance sheet. That means we've got a more accurate profit and loss. But if your balance is not accurate, your profit and loss is certainly not going to be accurate. So if people are looking at their profit and loss, right, and not looking at their balance sheet, there's a high possibility that what they're looking at is not correct.
Yeah. And this is all critical, in scaling the business and growing the business and being able to develop strategies for your business. But of course, then when it comes to exiting the business and getting your business ready for sale, then it's key again, because it can take years to fix some of these things up.
100%. And look, what's interesting is the thing that once people start understanding these concepts of working capital and debtors and inventory and how they relate to creditors, then you start getting different behavior out there. Like we've seen it with clients where, all of a sudden, they're more focused not only on winning a contract, but on the payment terms. They're talking about buying inventory for a job, but then they're also talking to the suppliers about getting extended terms to pay the supplier. So there's this level of consciousness that comes into play that helps them grow their business that, if they didn't probably have that awareness around the balance sheet, they wouldn't be looking at that sort of, they wouldn't be looking at those types of things. And so, and that's not only the owner, that's the employee. So it's really important not only for the owner to understand this, but to bring key employees on this same journey.
Yep. Oh, we've talked about this before. You need to put together a training course, Tony.
Yes. It's in I'm not going to make you a promise today, John, but yes, definitely. Given my imminent trip.
So how can people contact you if they...
Yeah, there's something here. Look, if people want to look, more than happy for people to, just have a review, no obligation if they just want to, I guess understand their profit and loss, cash flow, balance sheet. So more than happy to do that. And, we just need to get some financials. So if anyone's interested, then more than happy for someone to shoot an email. And again, there's, like you say, there's no obligation and that's fine. We all learn from everyone's experiences. We have a diagnostic too, a scale-up diagnostic. So if anyone would like to do that, and that can go straight to your inbox. But look, for me to email that to you. And secondly, the third thing is the slides. If you'd like a copy of the slides. So yeah, if people just please note my email address and send it to me, then I can either send you a copy of the slides, send you a link to the diagnostic, or happy to catch up for a coffee and just do a review of your, give you our insight on the review of your numbers.
And for people who are listening on the podcast, the email address is tonym@brentnallswa.com.au. So Brentnalls as in Brent. And now I've lost it.
You want me to say it? Oh,
yeah.
It's tonym@brentnallswa.com.au. And that's Brentnalls WA is one word, BRENTNALLSWA.com.au.
Okay. Anything else before we wrap up?
I think
No.
any questions, but I just encourage people to look at their balance sheets in a different way and start looking at them.
Okay, cool. And if anyone wants to find out more about what I do or contact me, go to johndenton.com.au and you'll find contact forms on there and a whole lot of information, copies of videos. And there's a page there with all my past podcasts on, and this one will appear on there soon. So I thank everybody for attending and sticking with us. I hope you got lots out of that. Please send me some feedback. That'd be appreciated. And I look forward to seeing you all on the next session. So it's bye from me, and thank you, Tony, again. And okay, bye now. So a great session there from Tony and some great insights into understanding balance sheets and cleaning them up. There was a lot of detail in that webinar and that presentation. So again, just to repeat, if you'd like copies of the PowerPoint, copies of the examples and case studies, then contact Tony at Brentnalls WA, Tony at brentnallswa.com.au, or you can contact me at john@johndenton.com.au, and I will put them up on my website in the podcast page there. Thank you, and I look forward to having you join me on the next Business Ready for Sale podcast. Bye for now.